We're going to be highlighting a young man named Andrew Lamb. He is the president of Buy and Build Advisors. He brings a rare combination of real-world leadership, M&A execution, exit planning expertise. And after 25 years, it's probably more than that, but he shortened it. For growth and exponential excellence in global markets, he now helps business owners build companies that are not only profitable, but transferable tomorrow. He's CEPA-certified advisor, founder, and creator. He understands that exit planning is not about selling a business. It's about creating freedom. Every time I have a potential client or even my own clients, we'll get into a conversation as your business is for sale. If not today, a year from today, 5 years from today, or when something happens to you on the ride home today, that your business now becomes a legacy or the estate for your family. So run it like it's for sale every single day. I'm going to turn it over to Andrew. And Andrew, why don't you tell us a little bit about yourself?
Morning, Paul. Morning, everybody. Tricia, thank you for the kind introduction. Great to be on the call with you all. So, Andrew Lamb, probably tell by my accent, I'm not from Houston, where I reside right now. I'm from far west Houston, which is Dublin, Ireland. I came here in 2001 with a little computer company called Compaq to run their knowledge management business. So, based myself in Houston for a number of years, then spent some time in Singapore, and then came back. So we're primarily buy and build advisors. Not only are we in Houston, but we're also in Utah and down in the valley at McAllen, where our other partners reside. But we actually help everybody across the United States. So buy and build advisors, we came together about 3.5 years ago. We've got some very distinct capabilities. Brittany with her fractional CFO like yourself, Paul, David with the legal and deal-making experience. And my part of this operation was around ops, looking at operations. So when we got into deal making and looking at businesses that wanted to expand or sell or buy other businesses, we brought a unique perspective of all three elements in one shop to that conversation. So that's kind of where we started and where we currently are today.
Well, you know, as you and I have worked together on some of the companies that you have taken through transition and acquisition, and in the process of that, two things happen. One, the company that's trying to sell many times is not ready to sell. They have to get to the point to where they can sell. But then the company that's buying them, they bought a new present. And it's like They're going to open up that present and here is what I have. And it's like, my goodness. So
it's a present.
It's always a present. So the reality of it is that you never know what you're going to get until you get there, unless you do the due diligence, understanding, work with a team that knows what to look for in a business and what's going to be things you're going to have to monitor and work with to transition that business. Because rarely are the two companies on the same operating system. They certainly don't have the same management team, so that has to be put into a culture building process, and they don't always consider that. That put in place is absolutely necessary. And Andrew, that's where you work with them on the front side to figure out what they have, what are they buying, how do they mold this together with a new operating team that, well, it's part of the same, but it's a new team when they're combined. We're going to get into why 11 of 12 businesses don't sell, which I think is a very accurate situation. I know with another company I deal with, they only sell 13% of all the companies that engage with them. So you want to make sure that you're engaging a partner that knows what they're doing and has a track record of closing once you're engaged. We're going to talk about the hidden reasons why they never transfer, why they never miss it. One of the first ones that come to my mind is a company and the CEO says, my business cannot run a single week without me. What does that mean to you, Andrew?
It means it's not sellable. Flat out, it's not sellable. And to be honest with you, Paul, this is probably a significant percentage of the businesses that are out there. So when we look at businesses like that, that is a challenge. And it's a challenge that can be overcome, but it can't be overcome overnight. So one of the things that we've got to look at is, when we're doing a CEPA, we're looking at 3 different legs of the stool. Number one, the individual themselves. Are they ready to exit? Because 70% of people that sell their business probably regret it about 9 months later because they're not set up for sale. They haven't thought about what they're going to do with their time. I interviewed somebody last week and they were like, so what are you going to do? He's like, less stress. I'm like, okay, so what are you going to do with less stress? He had no idea. None, zero. He's like, I'm going to jump in my RV and drive. Okay, where are you going to drive to? So a lot of people have no idea what they're going to do. And this is where they get lost. This is where they lose their identity, because most business owners, their identity is their business. So if you're going to sell your business, number one, you have to be ready in your own mindset. Not only you, but your family as well, by the way. Number two, you've got to have the financial wealth yourself. Do you have the money that you need to live your life beyond your business? Because that business is not going to provide for you anymore unless you do an annuity deal or a seller finance. But that money has gone away. You've got a lump sum. So now, do you have the right amount of money for your life? And that's called the wealth gap. That's one of the things that we look to individuals. And then the third leg of the stool is your business ready. So if you can't exit the business, let's say you're the best sales guy out there in the business and you're the one doing all the selling, what happens to that business if you're not selling? So those are the three legs of the stools that we look at all times when we're looking at businesses to truly understand, are they ready? Are they financially ready? And is the business ready? And if it's not, what do we have to do to get that business ready? Because very few people, I won't say nobody, but very few people want to buy an expensive job. Because if your business isn't set up right for sale, then the person that's buying the business is truly buying a job at the end of the day. They've got to go in, they've got to go fix all the things that you haven't fixed, right? A lot of people have never sold a business before. So let's use the analogy of buying a home. You've probably all bought a home or rented a home. You've looked at it. Are you buying a home that's ready to move in? All the floors are done, all the cabinets are in, the plumbing's there, the gas is there, the lighting's there, the landscaping is all done, and all you've got to do is put some furniture in. Is that what you're looking for? Or are you looking for a building that's on its last legs, that you've got to replace doors, you've got to replace windows, you've got to replace the floors, you've got to go up on the roof and replace all the shingles? Are you buying a flip? Now, some people like to do that, but I can guarantee most don't, because it's really, really hard work. So when you're looking at buying a business or selling your business, what are you buying? And this is one of the things that we go through due diligence. A lot of people look at the financial side of due diligence and they look at the legal. But to your point, they don't look at the operational side of the business. What's working? What's not working? What are they getting themselves into? What team are they buying? What customers are they buying? What job are they buying? What is the job that the business owner is doing that they're going to have to step in or do, or even bring somebody else in to do? And what is the cost of doing that? And we all know in this market, it's pretty hard to get really, really good people. But what's the cost of replacing that owner with another team member? And what's truly the cost of doing that?
Right. I've seen companies to where they would go in and buy, and if the term is Switzerland effect, that some aspect of the company is totally dependent upon a sold situation.
Mm-hmm.
If you've got one salesperson that drives all your business, be it the owner or even an employee that's a salesperson, or if you have a large concentration of your business in one customer, concentration issues will create a problem. It can reduce the value of the company 20, 30, 50%, or make it, as Andrew said, unsellable. So you need to work on that. So that's one of the things that Andrew's team goes in to help them build a succession plan, help them identify the things they need to do. From our standpoint, we help companies employ additional people to handle and split those duties to get them done and help build that out. Let's go to the next situation. Now you've got a company, they've got revenue, they don't know if they have enterprise value, they don't know what they don't know. Mm-hmm. What do you guys come in to do to help them understand what the value of their company is?
One of the things we do is we come in and we start looking at the business again from all of the different aspects. We're looking at it financially, we're looking at it operationally, we're identifying where there is the opportunity to improve the value of the business. And we look at an area called the 4 C's, the human capital, the customer capital, the structural capital, and the social capital. These are the significant value drivers of any business. I can improve a business multiples by several X without touching revenue. If you look at the 4 C's, the intangibles of a business valuation, you can significantly improve a business is worth from a dollar amount. I was doing one there the other week, and we were looking at the valuation, and the business owner said, I think it's worth $10 million. Well, it wasn't. It was worth $5.5 million. It was worth $10 million if he got out of the way, if he had all of the human capital working, he had, the teams in the right place doing the right things. They had some structural capital where the systems were working, the processes were working. Customer was good, right? The customer capital was very good. The social capital was very good. He had a great reputation out in the market. But with the human capital and the structural capital, he wasn't going to make that 10 million that he thought it was worth. But by looking at the numbers and improving those elements, we could get to about $9.5 million in valuation. So just looking at the intangibles of the business, his heart felt that it was worth $10 million, but on paper, the business was worth about $5.5 million. But when you started looking at the intangibles, you could bridge that gap to get it to where it was about $9.5 million. But again, that took time. It took effort. And unfortunately, as you know, Paul, there's certain things in business that we can't control, right? Himself above will decide when, sometimes we're going to exit, right? 50% of exits are forced. And that's due to either death, divorce, disability, distress, disagreements. Right? So you said at the very beginning, right? Your business should always be for sale. It should, for those reasons. Because if we're being forced to sell at a period of time, we may not be able to get the amount of money that we need to go on our next journey, to fulfill what we need, what we've committed to later on. So looking at the business, what it's worth today, what it needs to be worth, and the things that we've got to consider as we're going down that journey is really, really important. And that's why when people come to me and say, hey, I want to sell my business, when? My first question is when? When do you want to sell it, right? And how much effort have you got? How much time have you got to do that? If it's 2 or 3 years, yeah, we could probably do it in 2 or 3 years, right? But if it's like, I need to sell it next week and we have lots of, issues inside the business, then as you said, they're going to be taking a pretty large haircut on the exit value of that business.
Let's talk a little bit about what that revenue is.
Mm-hmm.
You're going into a company, buyers are looking for predictable cash flow, durable margins, right. Customer concentration, things that don't scare them. And a company that has transactional business versus tech-driven versus monthly recurring are going to have multiple changes. When you're on that transactional, you're probably going to be looking at a 3 to 4 multiple. Tech-driven, you might be 7 to 8. SaaS, you might be 11 to 12. So knowing that on the front side kind of gives you a little bit of an idea. But if it's not predictable, that company won't hold up under due diligence.
No, not at all.
That's the kind of thing of the revenue that you're going to be looking for to take to a buyer of what they have, what they can depend upon reasonably, and go with that. So if that's not there, that sale is going to have a real tough time surviving.
It's going to have a tough time surviving. It's going to have a tough time selling. But if you understand that early enough and address it, and I think this is the big learning is you've got time to fix all those things. It's about taking the time to go get it done and get it done right.
Well, one of the things that's going to immediately pop up, and this is a question that I'm going to put out to there as a comment, my leadership team and partners are not aligned, and it's starting to show. What does that do to the enterprise value and the value of that company in its entirety, either for the current owner or for a new owner?
Well, it devalues it immediately. If you're not in aligned, that'll show up very, very quickly. It'll show up with regards to the decisions that are being made. It'll show up with regards to the exit, right? We've had businesses that we've looked at where, one or two of the owners want to sell, but the other one doesn't. What part of the business are they in, right? If that distress or disagreements go on outside of the office, onto the floor, into the team, now you're going to have an environment that's not a healthy environment. That's going to permeate through the organization. That's going to be found. Are we seeing that with regards to the numbers? So again, disagreements, distrust, distress, things like that, those all permeate through the business. And then one of the questions we're looking at when we're doing, acquisitions is who's staying on? How long are they staying on? Why are they staying on? What role are they going to be taking? The other question is, and I had that the last week, was You've owned this business for 20 years and you want to stay in the business. When was the last time you actually took direction from somebody else, right? That's a hard conversation, right? I mean, you've been the boss for 20 years and you've told everybody what to do and how to do it. This new whippersnapper comes along, right, that you think is a whippersnapper and starts telling you what to do. How is that going to feel?
That kind of goes with the, even if you're growing, but if your operations or your communications are starting to break, most companies they don't die from lack of demand. They die from operational chaos that growth amplifies. And that's one of the disciplines that you try to address in going into small and mid-sized companies, to burn that issue out of the way, get it identified, get it corrected, and then try to move on. Tell me about when you go in and that situation's occurring.
So we call what's called an alignment. So with all clients, we sit down, we do an alignment. And the alignment is understanding what the duration of, let's say it's a 5-year period, a duration, because a lot of our clients are buying to sell. So we'll sit down with them all and we'll literally go deep into what their needs are personally, financially, and then where do they believe they want to be, exit. So I did one last week, actually. We're doing an acquisition. The good news was most of them were somewhat aligned in probably 70% of the areas. But on the other 30%, they were not aligned at all. So that's what we brought, was this clarity around, we want to get to X point, right? So everything I start with is a plan. So we all agree in 5 years, this is where we need to get to. Yes. Okay, and in 4 years, we want to get to, the next point. And we backtrack it the way through. What was not in agreement was the speed of execution on that. We had 2 people that were very aggressive, and we had somebody that was, I would say, more on steady growth rather than hyper growth. And she was not comfortable with it. So I actually went through the numbers with regards to a growth pattern, and then I translated it into her growth pattern to show you what the outcome was. And there was probably about a 50% reduction on what that number was at the end. And I asked a question, is that what you want? Is that where you want to go? And she was like, no, I don't want to go. I want to get to their number. I'm like, awesome. Now we understand that we all need to get to that number. Now what's the work that we've got to put in? What's the effort? What's the growth pattern? What's the trajectories that we've got to do year 4, year 3, year 2, year 1, 90-day planning? What does that all look like? And once we got that aligned, she went, now I get it. So the alignment is getting everybody to go, okay, now we know where we're going. Now we know what we need to do. Now we know what we're committed to and what the results are. And based upon that, now we can move forward with clarity. And again, those plans, I tell everybody, we should review those every year because, again, life changes. Things change in business, right? We should always be ready. You may get to a point where something happens in year 2 within your family that you have to exit. Okay, what does that mean?
Well, that brings us into probably the biggest question that comes around in an owner's mind. Every owner that has any desire in his own mind that, okay, I want to pass this on, I want to sell, transition to my kids, I want to do something, but I don't know if I'm ready. That's one of the CEPA frameworks, is when to start, how to exit readiness, planning on that before. And I've told every company I deal with, you want to sell, you really should start 2 years before you sell. Go into this discussion, go into the kind of things that we're talking about today, start evaluating that to get ready for that sale. Because as you said earlier, 50% are sold by necessity. Some event happened and it's going to be sold now for something. Well, that now for something is going to be potentially a great evaluation of the company if you don't have an alignment all the way down. I want to sell, I want to transition, pass it on, but I don't know if I'm ready. What do you do to go into that question?
Well, I would probably say it's probably a little bit longer than that, Paul, because you know as well as I do that you've got to produce 3 years of tax returns when you're selling a business. So one of the things you've got to look at is my business ready to sell, and are my books ready to sell? So making sure you're removing any of those add-ons earlier on, right? Pay more tax so your books look a lot better. But realistically, I think one of the challenges that we have is business owners think they have more runway than they actually do. The best exits are planned years in advance, not weeks. So we've got to make sure that, hey, this isn't saying when you sit down and have this conversation, it's not about I want to sell tomorrow. It's maybe not, I want to sell in 12 months. This is a journey. Where are we going? You mentioned I might want to hand it over to the children. Well, first of all, never hand the most valuable asset you have to anybody. You sell it, even if it's to your family. You sell it to them, right? Because they've got to have skin in the game. You also want that money, right? 80 to 90% of your personal wealth is actually tied up in your business. So why would you give that away? Number one. Number two is let's have a look at the gaps you can't see. A lot of business owners don't see the gaps, right? They don't understand what it's worth and where the blind spots are. So we go in and we look at what those blind spots are. Again, I go back to the analogy of the house. Does the house need a complete renovation top to bottom so it's ready for sale to get premium price? Or is it just a lick of paint on the front door? A lot of the business valuations, the multiple, the X's that increase it is down to the human, the customer, the structural and the social capitals, the intangibles of a business, not the financial numbers. So if we're looking at those multiples, the industry has multiples, as you said, but where you fall on those multiples is based upon how well your business is set up. And then the last one, right, is really about you can want a number, but it's only worth what somebody is willing to pay for. So having a business that's well set up, having your mindset with regards to what the business value is, why, and then understanding that where the market is today and what the multiples are in the market, right? Economy drives the market. Availability of cash drives the market. So there are external factors outside of your business that truly drives the value of your business, which then gives you what your multiples are, which is then your sale value. So I think that's what we want to do is we want to provide that clarity before capital. We want to provide the clarity that you have so that you're well armed, well read, you know your business, you know where the gaps, and you've closed those gaps. And then when the time comes to exit, you're ready for that conversation. And then from that conversation, what are your options to sell? Because there's multiples, as you said. There's exit to family members. There's ESOP, which is the employee owned. There is exit to PE. There's exit to strategic buyers. There's a whole host of options that are out there that we're aware of that may suit or may not suit your business or your industry.
Let's talk briefly about how would you prepare differently for family transition, same playbook, different ending, PE firms, things of the nature that are there. And one of the things that came up in a company that I was talking to recently, their first effort at trying to sell was completely blown up because it was owned by a group of family members. Everybody was in agreement, they thought, until one of the family members thought that he was more valuable than what the others did and didn't want to sell unless he got what he wanted. Now, the resolution to that is resolve that problem 1, 2, 3 years before you're going to sell. But if you haven't, what happens now?
That's a difficult conversation. I mean, it goes into negotiating, right? Again, it depends upon the legal structure of that business. Again, you go back into that. Is there a drag-on clause in the business? If you've got a majority of people that says, yes, we're going to sell, then they have to force that, then the remaining people have to sell. So there may be some legal requirements that need to be put in your operating agreement so that that doesn't happen, right? To your point, yes, we should be tracking this years out, understanding everybody's view on the matter. But you're right. I mean, deals get to the final stages and then somebody, for some reason, loses their mind. Let's be really honest. This is a very, very, very emotional time in people's lives. Because again, there's a lot of money involved, hopefully, right? But there's also a lot of legacy involved. So if that happens, I think honestly, we get into full-blown negotiation, right? I've gone through hostage negotiation training, right, with Chris Voss, never split the difference. But you've got to go through that conversation because basically what you're doing is you're trying to prise the fingers of that individual from the business so you can execute it for the good of everybody else. It's pure negotiation at the end of the day. But again, planning early and putting some legal structure and agreements in place that everybody agrees to early will mitigate that. Not solve it, but mitigate it, because you can always go back to that document. And then I would say every year, there has to be that review. There's the review with the family. Where are we? What are the numbers? What does that mean? If we exit this year, then Paul, you get this percentage. Andrew, you get that percentage. Shelley, you get that percentage. This is what it means to you, right? Are we all in agreement? Minute notes are taken at that point. So again, having these conversations on a more regular basis, having structure in place, right? That's the structural capital of the business, avoids a lot of these conversations later on. And if it does happen, then honestly, it's let's go. I attack the process, not the people. What in the process has failed? Where is it? It's not clear. Why are we at this point? What is it that's driving? It may be somebody in his sphere that's basically told him something on the golf course that's got into his head that's absolutely not correct, right? We find that all the time. Somebody got some advice from ChatGPT. Fantastic. Okay, cool. Right.
The source of everything these days. There's a CEO listening today to this podcast, and they've just realized they're not ready. What's the first phone call they should make this week?
Give us a call. So we'll actually do a valuation. So we actually do a 15-minute review of the business, and we take a couple of key numbers and just give you a quick value score, not only of the value of the business, but where your business currently is today. So we can do that pretty quickly, and it's pretty painless. After that, we can dig deeper. We can get really deep into the business and understand every facet and every element. But honestly, I would recommend everybody take the value gap assessment. That's on our webpage. It'll be on the link in this broadcast as well. But go take the value gap assessment and figure out where you are today, because, again, if you know today, you can plan for tomorrow.
What's the best owner-led business that you've ever seen, and what made it sellable?
Wow. Dear Lord, I'm thinking of a few ones now. I think the best one I saw was a tech company. The reason it was so sellable is they actually had the leadership in place. The owner was probably 2 or 3 hours a week in the business, well structured, well organized, had a CEO in place, had team were involved, compensation plans were all there. Everybody knew what they needed to do and where they needed to be. The culture was fantastic. They played very well in the community. And when we dug into the business, they ran processes and systems diligently. It just ran like a well-oiled machine. But that took a long time, and it took a lot of effort. But the big thing is, the owner was not in the business.
That comes up in almost every conversation of how much time. Can you leave for a week? Can you leave for a month? Can you take a sabbatical?
Some of them, can you leave for the afternoon, Paul?
One thing every owner should stop doing this quarter if they want to maximize value.
Stop doing everything.
Now that I understand. If you've got to do everything, you're the bottleneck. That also 100%. Means it's important to the business. Therefore, the business lacks in value, and it may prevent your company from even being sellable. The biggest myth about selling a business under 30 million in revenue.
Biggest myth. PE is going to buy it.
Say that again.
PE is going to come in and buy it from me for 6, 7 multiples.
They like big companies that have established everything.
Well, they like the smaller ones if they're doing roll-ups, but when they give you the first number, that's not the number you're going to be exiting with. So be careful with PE. And to be honest, I mean, they play well in the space that they're meant to play well, right? They're right there. But a lot of people see the big deals going on. They see the big numbers flying around. And realistically, if you're set up for PE, which is a different beast, yes, you can get some of the numbers that they're talking about. But selling to PE is a completely different beast than selling to a strategic buyer. A completely different beast.
Totally is. Let's go. If you could go back and tell yourself one thing on the day you left HP, what would it be?
Spend a little bit more time on me. I left HP and went straight into setting my own business up. It was COVID. I should have taken another 6-9 months off, to be honest with you. But I wouldn't be here today if I hadn't. So everything happens for a reason. But I think I should have taken a little bit more time off.
All right. Well, that kind of goes into you left a job, and company owners that are selling their business, in most cases, are leaving their job. And you alluded to it earlier that they haven't made a plan for what happens when. And they need to make that plan of Are they going to play golf every day? Are they going to have enough money to play golf every day? And et cetera. It's like, okay, they're going to be kicked out of the house by their wife because their wife doesn't want to have the CEO come home and try to manage her. All of the above things have to go into this play. Parting comments. What would you like to share with us about selling a company before we go into some questions here?
1 in 10 businesses sell today. 1 in 10. And most of those that don't sell is because they're not ready to sell. 80 to 90% of your personal wealth is tied up in your business.